bank bailouts have started. I'm your host, Steve Van Metre, and thanks for joining me today. Bankers are covering up the biggest bailout since 2008 out of fears of bank runs. Let's over to Bloomberg, where he picked today's story up with the headline, Swiss banks seek most dollars since 2008. It bid for easy profit or perhaps desperation. In Wednesday's auction conducted by the Swiss National Bank, 17 institutions took up $11.09 billion. That's the most since October 2008, when the global financial crisis was raging in the wake of Lehman Brothers' collapse. According to economists at Credit Suisse, Swiss banks swapped the dollars into francs in order to generate a profit. So I wanted you to understand here what you're hearing from Credit Suisse, which, mind you, I don't think has a lot of credibility. I'm not sure what you think, but I don't think they do. And essentially they're saying is, look, we're not in trouble. We don't need dollars. This is just an arbitrage opportunity. Are you kidding us? And I want you to see through this because I think there's something deeper going on here. The lenders can even sell the cash back to the Swiss National Bank using its reverse repo auctions or deposit it at the institution to benefit from a positive interest rate. Again, an arbitrage trade, not a demand for liquidity. We do not believe that the increased demand for U.S. dollar liquidity by domestic banks reflects any liquidity issues in the Swiss banking system, according to, again, a Credit Suisse economist. So notably, they come out in their report and say, look, we're just running an arbitrage opportunity here. We don't need liquidity. We're not in trouble. We don't need dollars. And I'll tell you what, it certainly seems like something big is brewing underneath the Swiss National Bank and Credit Suisse. The dollar swap facility, this of the Fed, was created during the financial crisis that began in 2007 as a lifeline to provide safe access to greenback liquidity, while the Swiss National Bank's cash-taking repo options are designed to drain excess liquidity from the market. And here you can see that these loans are not free. And here we go to the New York Fed website. And notably, they have not updated with that latest $11 billion. But you note there is a 7-day loan at an annual rate of 3.33%. So what I want you to understand here is the fact that the Swiss National Bank is having to borrow this money because the banks in its system need it. It means people cannot access dollars for any less than 3.33% APR. That's a significant issue here because the Fed, again, this is an emergency backstop that the Fed created. It's not some window where you go to run arbitrage opportunities, but notably, I want you to keep in mind, this is how it's being spun because if they can get through this problem, then no one's the wiser. If it blows up, well, we knew where it started. The Swiss National Bank does not disclose which banks borrowed dollars. Now switching over to the Wall Street Journal, the use of the Fed's dollar swap lines is often seen as a sign of stress in the financial system. And some are worried that Swiss banks were having problems. And that is, again, a key point because there's a stigma with using the Fed window. A lot of banks don't like to use it because it tells people that, hey, you're in financial stress. This is no different than going to the doctor because you have a cold. If someone said, hey, I have a cold, but I'm going to the ER, it's probably something more serious. And in this case, the Fed's window is the ER, not just a normal place you need to go to get dollars. But banks can borrow those dollars for a week from the Swiss National Bank via the swap line, then swaps those dollars for Swiss francs, but only has to pay around 20 basis points. It can then give those francs to the Swiss National Bank through a 1-week repurchase auction, which pays the banks 45 basis points, leaving the bank a profit of perhaps around 25 basis points. Some domestic banks can even make more if they have the capacity to park the extra francs overnight at the Swiss National Bank, where the policy rate recently went positive to 50 basis points. And again, all this is saying, hey, there's just an arbitrage opportunity. Nobody goes out and tries to run these kind of things for 20 basis points or 0.2% a year. This is ridiculous. I think there's something brewing underneath the covers here in the Swiss banking system. What do you think? We'll look to the comments to see. Do you buy it? Do you think they just are running arbitrage? Or is there a massive liquidity crisis brewing? Now, coming up on Friday, Jeff Snyder, Tracy, and I are joining the Traders Summit group for their upcoming event. We'll be live on Sunday at 10:45 Eastern to talk global macro and take your questions. Here's a great thing. The whole conference is free again. It kicks off at noon on Friday. And go to tradersummit.net. Sign up. Again, totally free. And we'll look forward to seeing you there. But are there some signs out in the global economy that perhaps would indicate that there really is stress in the system and a dollar shortage? Well, to that, we turn back to the Fed. The Fed's board sees 2023 shift with the end of front-loading hikes, and there's a problem because the Fed has aggressively raised rates here faster than they ever have before. And you do not have to think about what the reasonable level is, Bullard said. He said, our goal is to move some meaningfully restrictive level that will push inflation down, but it doesn't mean you have to go up forever. In 2023, I think we'll be closer to the point where we can run what I call ordinary monetary policy. If anything they do is but ordinary. You're now at the right level of the policy rate. You're putting downward pressure on inflation, and then you can adjust as the data comes in 2023. But Bullard has noted that he's more or less priced into the market for a 75 basis point hike, although he'd prefer to wait until the meeting to decide if his preference for the size of the move perhaps has changed. And I think that what we're going to see is this might be the last hike the Fed does. I have a hunch that going December, we're going to start to see the economy hit a wall. But these aggressive rate hikes by central banks would put stress on the system. That's why we see the dollar going higher. So does it make sense that indeed the Swiss National Bank is borrowing these dollars for its member banks because there's a dollar shortage? Absolutely. Tells you, and it reeks of a liquidity crisis. But are there other signs that the economy is hitting the wall and there's a shortage of dollars? Absolutely. Because one way dollars get around the world is through global trade, and that's crashing. Here we can see with this headline from FreightWaves that container imports to Los Angeles and Long Beach are plummeting. In LA, September imports are down 15% versus August. Now, some of this is due to negotiations with the union there, and some traffic is being rerouted to other ports, but it's still down significantly, even when factoring that, as the Port of Los Angeles reported total throughput down 21.5% year over year, exports up 2.6% year over year. And how about this? Port of Long Beach Executive Director Mario Cordero blamed the import decline on consumer and retail concerns about inflation, leading to warehouses filled with inventory and fewer product orders from Asia. Well, it's not fears of inflation, Mario. What the issue is, they don't have the money to buy all this stuff. Inflation isn't just a fear, it's a reality. And of course, what we're seeing is as all of these warehouses start to fill up, what it means is these shipments are going to stop and the economy is going to hit a wall, dollar goes higher, and of course, maybe something in the Swiss banking system blows up. But fewer ships are also being docked. You may recall back during the pandemic, there were over 100 ships at some times waiting to berth. Now, in recent weeks, the numbers have shrunk to much lower levels. The average from September 1st was 19 ships. There were 18 there on Tuesday, and there were only 10 alongside September 12th. Keep in mind, these are very, very low numbers. But one thing that isn't doing that bad and staying fairly low is initial claims, but one thing that isn't going down is the ongoing claims. We see state claims up 21,000 to 1.385 million. Meanwhile, initial claims are staying relatively low at 214,000. But will we see initial claims start to tick higher? Well, we will, because there are other signs that we're seeing now that perhaps this dollar shortage is real. There is a liquidity crisis brewing. Into that, we turn to the Philly Fed. And here we note in their manufacturing activity report, the region continued to get this decline overall this month. According to firms, the survey's indicators for general activity and new orders remain negative. That means heading lower. The shipment index was little changed. We'll assume that's going to head lower at a low but positive reading. The firms continue to report higher employment. So notably, firms are hiring, but that too, as we'll soon see, will change. And both price indices indicate overall increases in prices, not only received, but had. The survey's future general activity suggests the survey firms expect declines in the next 6 months. And here you can see in this wonderful chart, the current activity in orange is headed down following future activity. And what this means is manufacturers are predicting today that activity is going to slow. Let's go back and look at that chart again, because it's a really good predictor of where current activity is headed. And you can even note during the pandemic, activity crashed down, but future demand went higher and current activity swung up, this is a leading indicator of, again, stress in the system and that we are indeed heading to a recession. Now we'll take that Philly Fed data of new orders, which we know is still in contraction, and what we'll overlay now with the gross domestic product, or GDP, on a year-over-year rate of change. As we see new orders head down, it means the economy is indeed slowing down, and that would validate, again, that the Swiss are seeing a liquidity crisis. Firms continue to report price increases as prices paid and prices received rose modestly this month, following steady declines through the summer. But what does this mean for inflation and bond prices? Well, it actually means that the bond market is not following economic fundamentals, because if it was, rates should be headed down, not up. Check this out. Here you can see, again, current prices paid from the Philly Fed overlaid with U.S. Treasury securities 10-year yield. I have this on a year-over-year rate of change on the red line, and notice that the two are fairly well in sync. There's a nice relationship here that as prices paid goes down, then yields on a year-over-year rate also head lower. Here you can note, very unusual, you see prices paid coming down, the bond market not following economic fundamentals, suggesting that at some point, yields have a long way to go down to catch up to the economy. And how about what this means for inflation? Well, the CPI also following, of course, prices paid, tells us prices paid are heading lower, means also we should start to see inflation head down, at least in the coming months. Perhaps that will be the thing that puts the Fed on pause. But future indicators are deteriorating. They note the future general activity fell from minus 3.9 to minus 14.9, its fifth consecutive negative reading, suggesting, as I pointed out earlier, the economy here is slowing. The shares of firm expecting decreases in activity over the next 6 months, 37%, exceeded the share expecting increases, a mere 22%. The firm expects overall increases in employment, but I think that's going to change. But future employment index did only decline to 12.2. Let's check this out, because when we see a collapse in new orders here in blue, showing the Philly Fed data again, you see at some point there is an increase in initial claims, now looking at the 4-week moving average. And why is that? Because if there is a cancellation or decline in new orders, guess what you don't need? That's right, you don't need people to build them. And that is why we should start seeing somewhere here in the weeks to come an increase in unemployment. But is this bullish for the stock market? Well, not so much. Here you can see, again, taking the diffusion index for new orders, overlaying the Wilshire 5000 or the total U.S. stock market in red. And what we note is it should still trend down. It's not until the stock market starts to rally and push higher that it can actually signal a reversal in the economy. But those reversals, unless new orders turn around, will be rejected with lower stock prices. And so all this points to is it looks to me that the people at Credit Suisse are trying to cover up that there is a severe collateral and dollar shortage going on in the Swiss banking system, something that could lead to a massive liquidity crisis, and they're just hoping they can skate through it. But I don't think they will. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.